It's important to know where your money is going and how to put it there in the first place. Everybody wants to live off investments and have a portfolio that will sustain you for the rest of your life. But it's equally important to know how to do it and which way is the right way for you. This is Income Intelligentsia, real life advice for practical and financial goals. We've talked about investment opportunities in this channel a lot, and we want to go further and talk about the different styles of investment and how you can benefit from each one of them. It's all different with some similarities here and there, and if you're interested in finding out more, let's get to it. Before we hop on to the different types of stocks, we want to address risk tolerance real quick. Risk tolerance is someone's ability to handle fluctuations in their investments and potential losses. It's important to take note of this because different styles of investment have different risk factors, and not everyone is comfortable with taking too much risk for a potentially bigger payoff. What you need to take note of when assessing risk is your financial capacity, because you want to be able to recoup your funds if your investment doesn't pay off. Your time horizon, how long you'll want to keep it invested before needing to sell, your knowledge and experience in trading, and a healthy emotional and psychological mindset towards your finances. Knowing what you tolerate is key to understanding what kind of investment style suits you and to keep you comfortable with your investment choices. Most financial advisors often use risk assessment to assist clients with making better decisions towards their investments. Learning more about your risk tolerance helps you build an investment portfolio that you can be assured of. That said, we want to move on to how to actually start investing. One of the ways that you can start investing is by consulting with a brokerage company. There are companies with easier access and lower fees such as Robinhood and Webull, or you can go for established companies like Charles Schwab, Fidelity, or Ameritrade. They're fairly straightforward with their processes and you'll be trading stocks in no time. Now we want to start this off with one of the more popular styles, dividend investing. Let's say you want to live off a steady and passive stream of income and you're fairly conservative about how you invest your money. Maybe purchasing stocks from companies that pay their investors regularly through dividends may be for you. Dividend-style investing revolves around the idea that you buy a stock that pays you a percentage of what you've invested in regular intervals. This approach often pays off if you're someone that likes to hold on to stocks long-term. As you earn money from dividends, you can then reinvest them back into the companies that you want in order to compound it. That way, you can grow your portfolio along with the potential gains you can get regularly. The benefits of dividend investing are a passive source of income. It offers more stability than other forms of investing, and most of the time, they're companies that have already matured. Some examples of these are Texas Instruments Incorporated or TXN, Lockheed Martin Corporation or LMT, and Merck & Company Incorporated or MRK. One of the more important things to look at here are the dividend yields of a stock. A higher dividend yield, its sustainability, its history, the payout ratio, and the growth of the dividend are all important factors in determining if it's a good dividend stock to invest in. Knowing the track record of a stock, how much of a percentage of a dividend you get paid in, and companies increasing in dividend growth over time are all key factors in knowing how much money you'll get in return over time. Keep in mind, however, that dividend yields are heavily reliant on market conditions and can fluctuate with interest rate changes. While a high dividend yield is certainly attractive, it's also important to note the financial health of a company and its growth in its industry in order to future-proof your investments. In terms of negatives, dividend yields are not a fixed income source, so you're better with it if you're someone that is starting off and you want to understand the market more. Apart from that, the usual companies that give out dividends are companies that are already mature. That in mind, there's not a lot of room for growth as opposed to newer companies in an emerging sector. It's also not the most lucrative in terms of earnings as it doesn't offer the same amount of money as other investment styles. Next that we want to talk about is something that would be interesting for investors that look to hold long-term but want to grow their investment through growth instead of dividends. We're talking about value investing. The idea behind value investing is that you buy stocks at a low price, with the thought that these stocks will grow in price. It's like buying things at a discount and then holding on to them hoping to sell when the price skyrockets in the future. Value investors focus on undervalued assets in order to maximize their returns through growth. One of the more notable value investors is Warren Buffett, having successfully applied this principle over the years. The goal behind value investing is the potential capital appreciation that you gain from the company's growth. The downside behind this is you have to be knowledgeable enough about the trends in that specific market. If you're knowledgeable enough and you believe that the stock that you want will grow in the future, you're more likely to succeed than someone who just buys random cheap stocks hoping for them to grow. Which brings us to the next investment type as we want to talk about is growth investment. Typically, the companies you can buy stocks from are ones that are in their early stages of development or they operate in environments with high growth potential. The idea behind this is that you'd want to invest in companies that focus on innovation or disruptive technologies, which in turn becomes capital appreciation as opposed to dividends from dividend investing. With the upside being significant growth in capital appreciation, the downside to growth investing is the volatility of the market. It's essentially an educated gamble that you'd hope to win because you believe that the stock you're buying will be a dominant force in their industry. Compared to the growth you get from value investing, the returns on growth investing is a lot more, with it relying too much on having your risks pay off. While it takes more involvement, it's certainly one of the more risk versus reward types of investing strategies, and if you're fine with risking more, growth investing might be the one for you. Which brings us to our fourth and final investment style, which is passive investing. There's not much to say about passive investing apart from its strategy essentially replicating the performance of the market rather than trying to outperform it as with growth investing and value investing. These are generally done through a combination of index funds, which we made a video about, or exchange traded funds. This is the kind of investment strategy where you don't need to think much of the market and you don't have to actively manage your stock portfolio. Due to their diverse nature, you're also not risking a lot of your investment into one stock that may potentially fail. However, that also means that your returns are much slower, and as a result, it has limited potential in terms of outperforming the market. That said, there are no right or wrong styles in investing. With enough knowledge about the market and general financial sense, you'll be able to get better at investing. We do, however, advise that you seek more help if you feel like you need to make better financial decisions. It's always a good thing to ask your financial advisor whether or not an investment could be good for you in the long run after assessing your risk tolerance. If you've enjoyed this video and found this helpful, please hit the like and subscribe button. We'd like to be able to grow alongside you, and we're pumped to have you in our next video. Stay mentally healthy, and let's get financially fit together.